In this week's update, finally, US mega caps are capitulating. Review of the last 6 months and the commodity outlook. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, it's been a fairly tumultuous week last week, and certainly the US market on Thursday and Friday finished very, very negatively. So let's take an updated look at how the market sits. So it's really been a combination of the Fed, most of the Fed members just getting more and more bearish as the weeks go on, and particularly last week. And there were calls for rate rises of perhaps up to 0.75% steps, and that's really spooked the market, and that caused yields to rise, and that really has punctured the sentiment. But really, this is just the normal process playing out. As you'll see, the market peaked for small caps in November. One way of looking at the Nasdaq was something similar, and then we saw the S&P peak in early January, and finally the stocks, the big tech stocks that had held up the index, are now starting to break support levels. And so this is just a normal process, and this is why back in March I was really cautious about the 3-week rally that we got. I had to go with it because you've got to go with what the market is showing you, but I was always apprehensive about the US market because the process hadn't played out fully as it normally does. We hadn't had the panic sell-off. We hadn't had big technology stocks breaking down. And so that 3-week rally, I think, is just going to prove to be a bit of a fake. And we're now getting the completion of this correction process that didn't get done last time. So I just see this as quite a normal process. There's a lot of bearish commentary out there that the market is now going to fall a significant distance. And look, it might, but I don't think this is anything more than a normal correction. So first of all, small cap growth stocks fell. Then the mid caps followed. A good part of the Nasdaq started in the latter half of 2021, and now finally the mega cap stocks are starting to fall apart. And we'll look at quite a number of charts. But rather than get anxious and put off by that, you need to see this as an opportunity that's building, because we're still talking about the world's best companies. Truly great multi-decade companies are now getting cheaper, and you're going to be able to buy them for prices and valuations that we haven't seen for a long, long time. Now, most investors are going to get lost in the emotion of all this. They're going to be motivated to sell, probably somewhere near the bottom, because the pain just becomes a bit too much. But that is the absolute worst thing that you can do. So if you've caught out and you don't have enough cash, if you're fully invested, then it's not too late to do something about it. But I really do see terrific opportunities coming, because the mega trends are going to continue once this big multiple contraction plays out. We've got a completely different environment now. Interest rates have turned, they're going up, and that means that multiple contraction has got to take place. The stocks that were being priced for future earnings in a almost nil interest rate environment are just completely out of favour now, and may not be back in favour for many, many years. So we've got a different environment, and stocks are going to act accordingly, and so we've just got to play that as it comes. So I want to take a look at the last 6 months, because I think it's quite instructive to look at how this has unfolded and to put it all in perspective. So in November 2021, the XLY XLP ratio that I look at every week, so that's consumer discretionary against consumer staples, that peaked, and that was the first warning sign, and I started talking about this in November of last year, well before the S&P peaked. Small cap growth versus value also peaked in November, and we'll take a look at these charts. And then in December, we saw growth versus value roll over. And so did the NASDAQ. So let's take a look at a couple of those charts. So this is the S&P, first of all, just to sort of put it in perspective. So the S&P peaked on January 3 of this year. And it's been up and down, above and below the 200-day moving average ever since. But you can see what Thursday and Friday did last week. Very significant moves to the downside. And so this is, to a degree, this is money moving out of the market. This is more than just the rotation from aggressive sectors to defensive. So that was the S&P. So remember that number, January 3 was the peak, but it was only 2 days ago we were still sitting at the 200-day moving average. If we look at the NASDAQ, the NASDAQ peaked on November 22 and also December 29, if you want to treat this as a double top. But it's been below the 200-day moving average since January 20. There was only 1 day here where it spiked up and traded above it very briefly, but then that was it. And if we look at IWM, which is the ETF that covers the Russell 2000, then you can see that it peaked just a couple of days prior on November 8, but the small caps sold off, as would normally occur, much more significantly. In fact, we didn't reach the peaks in small caps that we had in the bigger indices. So the market was driven into November by larger cap stocks and particularly growth stocks. And then that all changed once we got into November, December. And the Russell 2000 has been below the 200-day moving average since the end of November. So very, very significant weakness there. And if we look at another representation of the NASDAQ, this is an ETF, WCLD, which I think gives us, it strips out to a degree some of the impact of the 6 or 8 major tech stocks. And it also peaked on November 9, and you can see just how steeply it has fallen, far more steeply than the Russell 2000. So that's the big picture. Let's look at some of the spread charts now. Okay, we'll start first of all with the NASDAQ versus the S&P. So this is the ratio. This is the NASDAQ divided by the S&P. So we had a peak in the start of 2021. We then got another peak at the end of November. So it was this chart starting to form lower highs and lower lows that I spoke about, and that occurred in late December, early January. So anyone who's watching these videos should have been on alert that there was a bit of a change in sentiment building in the market. Consumer discretionary divided by consumer staples. So if the line is falling, that means that consumer staples are doing better. That one peaked at the end of November. So that was the other key chart, and we clearly started forming lower highs and lower lows by early January. So that was when I was ringing the bell that you needed to be really careful in the market, because there were certainly things that were changing. This is the Russell 1000 growth versus value. So that rotation started at the start of November. Wasn't really evident until probably early January. So by early January, it was pretty obvious that all of these ratios and key charts that had been driving the trend in 2021 to the upside were all starting to reverse. And you can see we got this 3-week rally in from the middle of March, but that's proven to be just a bit of a head fake, and we're heading back down again. And all these charts are looking pretty ugly and pointing to more downside in the aggressive sectors of the US market. And this is the small cap growth versus small cap value. Again, as the line's falling, it means that money is rotating into value stocks from growth stocks. So let me just continue with this theme. So we move into January of 2022. The S&P peaked, as we saw, on January 3. And the 10-year yield started rising from 1.5%, and now we're almost at 3%. And I said at the time that that the multiple contraction correction was in full swing, and so there was plenty of warning before the really significant falls came. So let's now look at some of those other key charts. So first of all, the VIX. So if we look at the VIX over the last 6 months, you can see that we spiked to over 30, which is really a point of concern for the market. In early December, we spiked again at the end of January above 30. We had another spike early March, and we're heading back up there now, and we finished the week at 28.2. So certainly every time the VIX spikes above 30, it generally spells trouble for the market, or at least the US market. The Australian market, as you'll see, looks very different. Right, this is the US 10-year. Let's look at it over the last 6 months. And you can see that we were basically flat until January, around about the middle of, around about the start of January, it started to rise. So we were sitting around 1.5, 1.6, and now we've almost touched 3%. So clearly there is a direct correlation between the rise in the yield and the peaks in the equity market, and that's exactly what you would expect. Now, the other thing that sort of spooked the market a little bit is this 10-year, 2-year spread. When the curve inverts, it's pointing to a recession within the next 18 months to 2 years, and that generally points to a peak in the market. But as we saw back in 2019, the inversion only lasted a day or two, and then it immediately jumped back up again, and that was the case again this time. Although certainly that spread between the 10 and the 2-year came down in the last couple of days, halved from around about 0.35 and finished at 0.18. But nevertheless, it's still positive, and we don't have yield inversion at this stage. That's one less thing for the market to worry about. Okay, turning then to February. The VIX index, as we saw, spiked above 30, and it did it basically every month since December. The sell-off started to intensify, and the correction was really in full swing. And I was pretty vocal about that and the steps that you needed to take to keep yourself safe and to position yourself for the next set of opportunities. But through all this period, the Aussie miners were pretty much unaffected and were setting new highs. So our market, very, very different. We've got such a significant resource sector now, particularly with the weighting of BHP in the index. Whilst our banks dominate, they've done quite well, and they've done much better than US banks. So overall, a couple of major differences. The composition between the two markets are very, very different. And secondly, our large cap stocks didn't ever reach the sort of excessive multiples that the US market did, and so it just didn't need the washout. But certainly the mining sector has been a huge bonus for the Australian market. Moving into March, we got an emphatic mid-March reversal for 3 weeks. You may recall that the first week of that reversal was corresponded with options expiry, and on the Sunday I said I wanted to see another couple of days, so that was sort of into the second week of the reversal, because I just didn't believe it, frankly. The correction hadn't played out in the way that it normally would. You've got to wash the excesses out of the market for the correction to complete. So I was always pretty cautious, but after 2 or 3 more days of quite robust rises in technology, I had to acknowledge that that's what was happening, and signalled it accordingly. But it only lasted another week and a half, and we rolled over, and we've been heading down ever since. And I think it's just been the high inflation readings that came through just finally got to the market, and down she went. And then we come into April. The rally's run out of puff now. It's reversed very sharply, as we've seen. And certainly in the short term, the Fed rhetoric wins out. But I still believe that there is a chance of what I've been saying all year, and that is the inflation readings look very high because they're compared to the same month in 2021 when inflation was relatively low. And so, of course, the numbers this year are looking really bad. But in April, May, June in 2021, inflation started to pick up. And so unless inflation really gets out of hand, in the next few months, the relative figures are going to start to look a bit better. And that, could well take the pressure off the Fed, and they might just back off their language a little bit. So I still think I want to see this play out. I want to see the large cap stocks sold off, get some of those multiples down. But I still think that, we can have a pretty decent second half of the year in America. But certainly parts of the Australian market, I'm just super bullish on those parts of the Aussie market. So, summary of the American stocks, the S&P was down 2.8% for the week, and it really is starting to look pretty ugly, and I'll show you some individual stock charts in just a moment. So the 3-week March reversal, it was just an aberration. It was a head fake just to fool us, whether it's computer algorithms that were responsible for that, who knows. But it's pretty obvious now that we're going down further. And the other thing that's coming through now is that earnings results, or some earnings results, are starting to fall short of expectations. And we saw Netflix absolutely smashed, and there's been a few others, even in defensive areas like healthcare, as we'll see. Now, the US dollar index, through all this, with the talk of having to raise interest rates faster at the cash rate level, the index is moving up. It's now above 101. The yield finished at 2.9 and the VIX at 28.7. So let's take a look at some very interesting charts. And we'll start first of all we'll start with Google. So Google has been holding up probably as good as any of the mega tech stocks, but you can see on Thursday and Friday, and particularly Friday, fell very sharply, broke key support, and look at the volume on Friday. This is serious move out of stocks like Google on Friday. So this is institutional money moving out now, and it's absolutely odds on that these stocks are going to go down further. Now, of course, in the very short term, they can get oversold and we get little bounces, but I'd put a lot of money on the fact that Google's going to be cheaper over the next few weeks or few months. And we could even get down sort of 2100, 2200. But there's nothing changed with Google. It's still one of the world's very best stocks. It's still going to do incredibly well over the next 5 years and decades beyond that. So there's going to be a great opportunity to pick up a tremendous long-term investment in Google. It's not there yet. This is HCA, which is one of the largest US hospital groups, very much a defensive stock. But look at what happened on their earnings on Friday. Absolutely brutal. And any disappointments in this sort of market are just going to get absolutely smashed. This is ISRG. This is a really interesting one. They reported after the close on Thursday and actually beat expectations, and beat expectations comfortably. But look at what the market did to it on Friday. So this is a very high multiple stock. This is a stock like CSL or Cochlear. Those sort of stocks always trade on a high PE multiple, and this is a company that makes robotic surgical equipment. It's a fabulous stock, but it was just very expensive, trading on a high multiple, and that obviously came out with gusto on Friday. This is Netflix. Netflix was already in significant decline. It had peaked in the middle of November. So Wall Street analysts had a bit of an idea of what was coming, but for the first time in its history, Netflix declared a significant reduction in subscribers, and look what the market did to it. It was down about 35% and failed to bounce. Look at Facebook. Facebook's been in trouble for quite some time, since September. So it rolled over well and truly before the rest of the market. And you'd be a brave person to say that there's not a lot more downside in store for Facebook. And finally, this is HYG, which I show every now and again. It's an ETF that covers effectively high yield junk bonds, and it is in significant decline, as you can see. So the bond market being sold off for a while, that's good for equities because money comes out of bonds, goes into stocks, but then eventually the market just gets very nervous and starts to sell out of stocks as well because of the potential disruption. Turning to currencies, this is the US dollar, so very steeply in uptrend now, and I guess probably got a good chance of getting back to the highs that we saw in at the end of the COVID crash. So finished 101, and accordingly the Australian dollar, which had been holding up very well because of commodity prices, and it really did take a smacking on Friday and closed at 71.74. So just to summarise, 71.74 is where our dollar finished. Now our index only dropped 0.7% across the week, and all of that and some was on Friday. So one would expect when our market reopens on Tuesday that unless there's a rally on Monday night in the US, expect a fairly sharp decline in our index on Tuesday. But look, resource pricing remains strong. As we see when we get to the base metals and crude oil. And so the outlook for Australian small cap mining stocks and large cap mining stocks is still very good. However, there are some stocks that have gone up quite significantly in the last few weeks, and they're the ones that are going to be at the short-term risk of profit taking, because there's so much profit baked into them that traders just get a bit indiscriminate about how they sell out. So I think we're in for some significant volatility over the next couple of weeks, even in the resources sector, which has done so well. So let's just take a quick look at the Aussie indices. So there's the ASX 200. All the damage done on Friday. I guess there was an idea in the Australian market that there would be some significant selling in the US on Friday night, and so our market was sold off, and probably overseas investors can use the Australian market to hedge against a gap opening down in the US. So that's why often we see our market move before the US. It sort of seems like the US follows our market, but that's not really the case. Now turning to precious metals, this is gold on a weekly basis. It's still struggling to break out, and in this environment you would have thought, it just doesn't get much better than this for gold, with all the geopolitical issues and the inflation issues, but it's still struggling. Now part of that, of course, is the fact that the US dollar has gone up, is providing a bit of a headwind, but gold is still disappointing. There it is on a daily chart, and if we look at silver down sharply Thursday and Friday. Turning now to the miners, we had a little breakout, but that all finished last week. So again, a bit of a false breakout, and now we've gone back down quite sharply in the miners. And if we look at the spread chart, let me just find the appropriate one. There we go. There is GDX versus GLD. So we've had quite a sharp move down. So this line falling means that gold stocks are being sold off faster than gold itself. So we had a hugely positive run up from the lows at the end of January, but that has now been stopped dead in its tracks as well. Okay, so just completing on precious metals. So gold down $41 to 1933. And it's trying to gather some extra momentum, but just can't seem to do it. It should really be doing better, a lot better than it is. GDXJ down very sharply as we saw, and that's why I've been talking about the fact that any gold stocks that I'm buying are not the producers that need a gold price to be higher to go up. I'm targeting stocks that have got a very good case for going up regardless of the gold price. And I just think that gives you an extra layer of protection. Other commodities, copper, steady at 460. Nickel was up to 1522. So there's no real weakness there despite the US dollar going up. And I talked about this in depth in Portfolio Analysts through the week and showed a chart, the fact that the copper production from existing mines is forecast to peak in 2024. And at the same time, we've got demand rising steeply in a straight line. So if you've got demand going up in a straight line, you've got existing production peaking and rolling over quite sharply, then to keep in balance, obviously you need a lot of new production to be brought online, new mines. But you can't just bring those mines on overnight, not the big ones that make a difference. It takes sometimes up to 5 or 8 years to get a decent sized new big mine into production. So it's almost certain that we are going to get a significant deficit and therefore higher prices in most of the metals is going to be inevitable. You know, unless the world was to suddenly decide to back off the theme of decarbonisation, or global growth absolutely collapsed, and it's almost impossible to see either of those eventualities, then higher metals prices look to be baked in as far as we can see. Now, crude oil was down a little bit, down about $1 to 101.75. So looking at those charts, there's the spot copper chart, not much change there, but nickel did manage to edge up a little bit. So a lot to cover this week. Wrapping it up, what can we learn from the last 6 months? Well, I think there's many things that we can learn, but one of them is that logical conclusions, which we sort of feel like it should play out that way, but logical conclusions are absolutely worthless in the short term. Just look at that chart of ISRG, beat expectations and yet got sold off by something like 18%. And there's just hundreds and hundreds of logical conclusions that have not played out the way you would expect. So if you're trading and investing on the basis of what's logical, then you're probably going to get your timing completely wrong. The second thing that I really learned from the last 6 months is that you need discipline. Not that I needed to learn this. I've known this for many, many years, but it just gets reinforced. You need discipline to respect the big picture shifts in rates. We had a 4-decade bull market in bonds and therefore a bear market in interest rates, and that all reversed. And at the same time, we had stocks trading on incredibly high multiples on the basis that interest rates were going to remain low forever. Well, those two things were never sustainable. And also the business models. There's a big shift in the way the market looks at the business models. Going back to 2017 through to 2020, the market was prepared to pay up massively for stocks that weren't going to earn a profit for years and years, but they were growing their revenues strongly. And in Australia, you've only got to look at stocks like Afterpay Touch that just went up to astronomical levels, multiples of revenue with really no visibility on profits. But the market cheered and applauded all the way. But now it doesn't. It just doesn't want to know about those sort of stocks. It wants earnings visibility. And you've just got to recognise that that's the change. And you've got to go with it. So we need to be flexible in our response to what the market is doing. And I stand by the calls that I made in March. The fact that I didn't trust. I didn't believe the fact that we should get a rally. I didn't believe the fact that we should get more of a correction unfolding. But when the evidence was there in front of us, with growth stocks rallying really strongly, then you've just got to go with it. So even though it double crossed us, it was still the right call and the right move in my view. The final point, and I get this from some people who aren't members and they, I think, have this need to feel that they're right. They beat their chest about their predictions, but heroes never last in the market. You've got to be humble, and you've got to go with what the market gives you and respect the direction. So heroes never last in the market. I think that's a really key lesson. Our portfolio analyst last week, I covered a lot on commodity intensity in both the electric vehicle space and also in the general energy space and renewable energy space. And those charts were an absolute eye-opener for me, because it just showed the incredible step change in commodity intensity required to meet the demands of electric vehicles and renewable energy. It really is quite extraordinary. Also looked at tin and copper. Been looking at all the other metals over previous weeks. We also looked at how to use stop losses effectively, the process that I've sort of fine-tuned and been using over the last 5 years or so. Has the capacity to get you out much earlier than most techniques. And also covered some more high conviction stocks, of which there are very many, particularly in Australia, but also in America. It's just in Australia, some of them are good buys now. In America, I think we've got to wait a little while longer yet before we get to that point. So that's it for this week. Big video, but I think a really important change in the market. So it'll be fascinating to see what happens next week. There's more information on the website. There's my email address, and I'll be back with you next Sunday. Cheers.